Welcome back in, everyone. I hope you're having a good day today. The stock market always has opportunities out there, even when we're at all-time highs or when we're at the bottom. There's always an opportunity, there's always a bull, and there's always a bear market in some part of the market. With that being said, there's not always an opportunity for every investor. Pretty much every investor in the world should not have 99% of the investable stocks in the world on their radar, on their watch list, or in their portfolio. As Buffett says, investing is a lot like baseball. You get to sit there in the batter's box. The only difference is there's no called strikes. So you can sit there waiting on opportunity after opportunity to go past you, waiting on the perfect pitch, and then you swing big and you swing hard on those pitches. Monish Pabrai, another great investor, he says you want opportunities to come and hit you on the head with a 2x4, that you want them to be so obvious. And today there are some of the most obvious opportunities that I've ever seen in the market. I've been investing for 5 or 6 years now, and I'm getting better as time goes on, but these are some of the best opportunities, some of the most shocking opportunities that I've seen in the market. Even compared to 2022 as well as the April 2025 sell-off. I think right now I've never seen this many very obvious opportunities in the stock market in my 5 or 6 year tenure in investing. So I kind of wanted to go over my reasoning for why these opportunities are standing out to me and what they are today. So let's go ahead and dive in. Before we get started, I want to preface my strategy and how I do this, how I go about this. I get a lot of questions asked about how I make these decisions and what I'm looking at, why I'm selling, and why I'm buying stocks. So what I do is I study businesses. I look at businesses. I don't look at stocks, stock prices, and then look at the business. I look at businesses. They could be at all-time highs. They could be 100 times overvalued, like something like a Palantir or a Tesla. Those companies are super overvalued, but I do think, Tesla and Palantir are solid businesses. But nonetheless, I look for great businesses, and I look for companies that are really high quality, that have wide moats, that have organic growth, meaning they have somewhere to grow in the future. I believe the future is going to benefit these companies. I'm looking for high returns on capital employed, which is basically every $10 that you put into the company, into products, into services, into infrastructure, you're getting a good return on that $10, up to millions and billions of dollars. And I'm looking for good management teams that have strong capital allocation practices that benefit the shareholder, that put the shareholder first. And I put those companies on a watch list and I sit and I wait. I wait for opportunities to come at me. And here today, Adobe is a screaming opportunity. This stock has been absolutely battered. It's down 26% year to date. I was buying the company last year. I'm going to be completely honest. Over the past 1 year, it's down 37%. I started buying shares in the high 380s. I was buying at like 379, 381, 385. I was buying here. I bought all the way down here. I bought throughout the end of the year, and I've continued to buy this year. I bought some shares under $250. So my average is in the mid to low 300s. I believe it's around 338. And today you can buy shares at 247. And the way I see this is I see Adobe as a monopoly. There really isn't a second place, especially in the enterprise creative suite space. Every big company, for the most part, I believe 98% of the Fortune 500. So of the 500 biggest companies in the world, 490, give or take, use Adobe, and they rely on Adobe for their marketing, for their advertisements, for, collaborations between people. If it's a restaurant, they use it for menus. If it's, anything that has any kind of branding, they're going to use Adobe Software Suite. Any kind of content creation, whether it's movies, shows, whatever it may be, anything creative, anything visual, they're using Adobe. And every college that, these workforces are coming from for creative professionals, they're all being trained on Adobe. So this is basically the Excel of creative. That's what Adobe software is. There's no second place. Sure, there's things like Canva and Figma and other resources that are, good to use for maybe freelancers, very small business owners, or content creators. Like me, I actually use Canva. I don't use Adobe. I've used Adobe before, but I'm not making high quality content. You guys have seen my thumbnails and my videos. This is nothing special here. I'm just kind of throwing it together. So it's much cheaper to pay. I think it's like $15 per month for Canva than it is $50 for Adobe software, which does a lot more, but I don't need that. So, but Adobe it's crucial. It's what everyone runs on. Like I said, it's like the Excel. So this company's a monopoly, and then you look at the fundamentals of the company. So you combine all that with the fundamentals of the company. Like I said, we have revenue here. It's just up and to the right constantly, nonstop. It's over the past decade. It's grown at 17% per year annually. It has slowed down here recently, but I mean, Look at the number. It's getting 24, 25 billion dollars of revenue every single 12 months at this point. It's not going to grow at 20%, 30%, 40% forever. At that point, they would be the biggest company in the world if they were able to do that. But they're still growing really fast. This is very fast growth. 11% growth is nothing to, downplay or anything like that. You're getting the company at a 10% free cash flow yield. We'll get on that later. Let's look at the free cash flow. The free cash flow per share, which is what matters. Over the past decade, it's grown at 22, almost 23% every single year on average. That is phenomenal growth. Even over the past 1 and 2 years, you're looking at 18% and 31% per share over the past 2 years. That is like insane growth. That's super fast growth. Some of the best companies in the world don't even grow that fast. Some of the most hyped up, the big AI plays, some of them don't even grow that fast. But earnings per share, same thing. So the net income per share of Adobe has gone up 27% per year over the past decade. Over the past 1 year, 13%, nothing impressive. Nothing crazy, but it is very impressive. Over the past 2 years, it's up 28% per share per year. Over the past 5 years, it's a little slow, but we did have a one-time, benefit here in 2021. So that's a little fake. This would be, if this was, back down to $10 per share. So this would be closer to like 12% per year. So still very fast growth. The company thinks it's undervalued. As you can see, this is the amount of money they're putting into share repurchases, basically paying back money to the shareholders. This is the same thing as a dividend would be, but instead of you getting the cash and paying taxes on it, you get granted higher ownership of the company. So Adobe has absolutely ramped this up, especially with the recent sell-off. And with that, they still have a lot more cash than debt. They still have over $1 billion more cash than debt. So, and with those buybacks, you're seeing the shares outstanding be reduced by more than 2% per year over the past 10 years. So your ownership stake, it just goes up so much. So the pie of the earnings and the free cash flow that you're getting each year is going to continue to go up so much. They said they plan on continuing advanced buybacks. And then the valuation of the company has just been hammered. As you can see on a price to earnings, this company is down to a 14 price to earnings. And historically, you've seen it trade in the 60s, the 50s, the 40s, the 30s. Because like I said, it's such a high quality company, but Wall Street, they cannot stand uncertainty. And a lot of times that just causes unrealistic and stupid sell-offs. I agree. There is some uncertainty, so maybe you could have re-rated Adobe. Maybe Adobe was expensive here at a 60 price to earnings, which I wouldn't have paid a 60 price to earnings for Adobe. Like I said, I had it on the watch list in the 50s and 40s when I figured out that this company was a great company. But I just let the valuation run down to me. I saw it get down to the 20s here in 2025 and into the teens, and I was like, oh my gosh, I'm getting a phenomenal company. It's a monopoly. It has, all the traits that you want for a great company. It's continuing to execute. The only thing that has changed is the narrative around the company and, the stigma around Wall Street around the company. So a lot of times they'll just put down a company because something is, is evolving, it's changing, and they just run for the exit. And that causes an unreasonable sell-off, which is what I think we've seen here with Adobe. If the stock price was continuing to go up and to the right, all you would see online is how AI integrations into their software is going to provide more value for the customer. They're going to be able to flex even more pricing power. All the windows that it's going to open up for Adobe and all the new announcements, partnerships with NVIDIA and Google and OpenAI and all this stuff, it would all be just great news for Adobe. It would send the stock up. Each earnings report where they double beat on revenue and earnings per share, the price would continue to climb. But since the narrative around the company has changed, until it changes back, which it will one day, unless they do get disrupted, but unless one day the narrative will change, like I said, and then all these headlines will start to be, plus 10% move for Adobe, plus 5%. So I'm not too worried about this one. Like I said, I am down like 20, 30% on this one. I believe it's somewhere in the 20s. I'm going to continue to buy more. And like I said, you're getting 10% return on your investment per year in free cash flow. It's 8.2% after dilution, but if they continue to grow this at even just 10%, which is much slower than it has been historically, all of these numbers are above 10%. If they grow it at 10%, you're going to get paid back in cumulative free cash flow from this company within like 7 years, which is unreal. Something has to change. Adobe really has to be disrupted. And I just don't see it happening. This one is just screaming at me. It's not, it's not kind of cheap. It's super cheap. It's like a commodity multiple on one of the most monopolistic, one of the most dominant and fast growing companies in the entire world. So this is opportunity number one that I wanted to go over with you guys. The second company that's just screaming at me recently is MasterCard. This one's nowhere near as cheap. I just want to preface this. But I do think this is a slightly higher quality company. I do think they will see faster growth, and they're kind of accelerating into growth where Adobe is slowly decelerating at the time being. But this company's still been hit. You know, over the past, year to date, it's down 11%. Over the past year, it's down 8%. And over the past 5 years, it's only up 40%. So the company, and in that meantime, you've seen revenues go from, let's say, it's at 33 billion over the past 4 months. Let's go to Q4 2020. And we're looking at 15 billion. So revenues have over doubled, yet the share price is only up 39-40%. Same thing with free cash flow here, especially on a per share basis. Over the past 4 months, we're looking at, past 4 quarters, we're looking at $19 per share in free cash flow. And you go down to Q4 2020 right here, you're looking at $6.50 in per share free cash flow. So that has basically tripled in free cash flow over the past 5 years. Yet the stock price is only up 40%. If they were to follow in line, obviously this would be a lot different, and that shows in the valuation. Let's pull up the free cash flow yield. Over the past 10 years, right now it's sitting close to a 4%, about a 3.8% free cash flow yield on the company. And you had times 5 years ago, so March 2021, we were sitting at a 1.7% free cash flow yield. So the valuation is over 2 times as cheap as it was 5 years ago. And that's why, you know, I think the company was very overvalued in 2021, as most of the market was. I learned the hard way. But now the fundamentals have just simply caught up to the valuation, and now it is like underpriced. It's very cheap. And the quality of this company almost cannot be disrupted. The weight of the whole world economy is weighing on Visa and MasterCard's payment rails, and we're seeing acceleration within their value-added services segment, as you can see here. That's up 23% over the past 1 year. It's about 40% of their total revenues already. And with the explosion of the value-added services segment of this business, it's strengthening their moat, it's strengthening their competitive advantages, and it's taking away a lot of the risks that they face from regulatory pressures. So at this point, you know, if value-added services continues to be very high margin and grow very fast, they won't have to rely too much on the pricing power within the payment network. As long as they keep those payments coming in, you know, they have billions of cards. As you can see, 3.4 billion MasterCards. So they get all the data from those cards, and they're able to repackage that and resell it as value-added services to institutions. So that is really reducing their risks from regulatory pressures. So everything's going right for the company. The price is just going down. I see this company trading at a 30 trailing price to earnings and a 3.8% free cash flow yield for one of the highest moat companies that I've ever seen. It has a 5-sided network effect. Every person that enters into their network, whether it's a bank, from a bank of the merchant, a bank of the consumer, or a merchant or a consumer, it all benefits all of the other players, and it benefits MasterCard. That's the 5th player. So for someone to uproot this, they would have to come up with something that's more secure, that has more value for customers, given their point system. You know, a lot of cards, they give 1, 2, 3, 4, 5% cash back, given on what you're spending on. And it benefits the banks and stores and whoever that's giving out these credit cards, as well as the banks of the merchant and of the consumer and MasterCard itself. So this one's it's just not going to go anywhere. I cannot see a world where something disrupts MasterCard. Anything is possible. But this one's it's just like, why is this company at a 3.8% free cash flow yield? That's what I keep saying. That's what I keep asking myself. So I continue to buy shares. My average on this one's about 520. So I've done pretty good on this one. I timed this pretty well. Like I said, it hasn't moved too much over the past year, but it is cheaper than my average now. I think right now MasterCard is a screaming opportunity. The next one that just doesn't make much sense to me, as you guys can see if you've watched my recent videos, these are my top 3 positions: Meta, MasterCard, and Adobe. By far, they're like 13, 14, 15% of my portfolio, and I'm in the red on all 3 of these positions. I plan on continuing to add. I might even concentrate my portfolio and get rid of some of my smaller positions to add into these, because these just don't make sense to me. I think the returns will be very, very great on these over the long term, and I think I will be able to beat the index with these 3 opportunities here. But let's go over Meta here. Over the past, year to date, it's down 7%. Over the past 1 year, it's down only 2%. But from the highs here, we saw the company get basically almost at $800 per share. And right now it's at $600. We saw it dip below $500. So a significant sell-off from all-time highs. Even here, earlier this year, it got up to $740 shortly after that earnings report. And now we're back down. We were under $500 a share last week. Now we're right at 600. But this is a company, it's trading at a 25 trailing price to earnings and a 3% free cash flow yield for what I believe to be the strongest moat, the widest moat within the Mag 7. I don't see this company it's irreplaceable. It has half of the world using one of their applications, one of their platforms every single day. It is the company that has seen positive, return on investment from artificial intelligence. They've seen the average revenue per user right here. It has just skyrocketed over the past year. It's up 15%. Over the past 2 years, it's up 28%. And over the past 5 years, it's up 15% due to this recent run up here. So they're actually seeing, artificial intelligence help the company, help it with targeting ads, and help it create value for the advertisers on the platform. And I believe this is going to continue to happen. Artificial intelligence is going to make the platforms better for the users, and it's going to make it better for the advertisers that want to get more, more engagement, more users, more sales from these advertisements. It's going to continue to go up, which is going to cause Meta to be able to charge more per ad, and it's going to drive up this average revenue per user, as well as the family daily active people, which is the amount of people that are using it, one of their platforms at least every single day, continue to go up because, like I said, it's going to make the platform even better. This number is massive, and it's growing 7% over the past 1 year. Over the past 5 years, it's grown about 6% per year. So I expect this to grow, 6% annually going forward for the next 5-10 years. And like I said, it's just the biggest network effect in the world. Half the world uses it every single day. I'm sure more than half of the world uses one of their platforms, whether it's WhatsApp, whether it's Facebook, whether it's Instagram, whether it's Threads, whatever it may be, uses their platform, on a monthly basis or, a lot less frequent than daily. So almost the whole world's on it. More of it's going to continue to be on it through, I believe, one day. I don't know when. I don't know. This might be 10, 20, 30, 40, 50 years down the road. I believe one day we'll see Facebook and all this stuff within China and Russia. So they have a lot of market still to take if that were to ever happen. That would be phenomenal for the company. With all that said, the company's trading at a 25 trailing price to earnings, roughly a 20 forward and a 3% free cash flow yield, while at the same time it's growing revenues at 22% year over year. Over the past decade, it's grown revenues at 27%. This is phenomenal, similar to the last two companies we looked at. And the net income, they had a one-time, let's look at the quarterly here so you can visualize this. They had a one-time hit here, a big tax hit. This would have been, in between the 18 and 22. It would have been roughly 20 billion here. So that's like a 17, 18 billion dollar tax hit that's shown on the net income. So this 25 number would actually be like a 22, 23 if you take out that one-time tax hit. And with that one-time tax hit, taken into account, over the past 10 years, it's still grown at 32% per year. This chart right here, it would be up here. It would be, like 80 billion over the past trailing 12 months without that one-time tax hit. So yeah, I mean, the company's growing really fast. You can see it in the free cash flows. Free cash flow per share is growing at 24% per year. This is going to continue to decelerate in the short term due to the large capex spend that they're spending on AI. Like I said, I do think the company is going to be able to get great returns on this artificial intelligence long term. And if they do spend too much, they will be able to sell this and lease it out to other competitors, other players within the tech space. So I do think it's a great investment. As you can see, the debt went up because they all had an offering to do this AI build out, but they still have a lot more cash than debt. They still have 23, $24 billion more cash than debt. No big deal there. Oops. And then the return on capital, they just started a dividend. Not too sure about that move, but it's fine. It's very small. And then let's look at the valuation. Historically, this company hasn't drawn a too high of a valuation. This was one of the best opportunities in 2022. I missed it. I was still a very new investor. I spent a lot of time buying ETFs in 2022, so I did very well there. But since before 2022, before 2020, really, it hasn't drawn a very high multiple. The heights we've seen are in the high 30s here in 2023. And right now it's trading down to a 25. Like I said, without the one-time tax hit, it's actually closer to a 22, 23. So it is very cheap. It's not as cheap as it was in 2022. I don't know if we'll ever see the company get that cheap. But nonetheless, I see it at 25 price to earnings. I think the company will be able to grow within, earnings per share Honestly, it should grow faster than revenue in the long term. So if they continue to grow revenue at 25%, I think they guided for 23% for the full year. That's a rough number. Don't quote me on that. It might be even more or less than that, but I believe it's right around 23-24% for the full year of 2026. So if we get to see earnings per share grow at 20%, you look out 5, 6, 7, 8 years, you're getting it at like a single digit earnings per share in the future for this company. And that's just going to provide great returns. The company has, like I said, has such a wide moat. I don't see it going anywhere. I don't even know if you give someone $100 billion, $500 billion and said, hey, go replace Meta's platforms, Meta's applications. I just don't think they could do it. I don't think they could get the people to switch off. It has such a strong network effect within the users and the merchants, advertisers on the platform. I just don't see it happening. So this one's just been screaming at me lately, and I've got one more for us here. Last one here is PayPal. This one's going to be controversial. A lot of people hate this company. I mean, there's been investors that have owned it for the past 5 years. And if you paid, 5 years ago, let's see where it was in March. So it's the end of March. Right here, you paid $242 per share for PayPal 5 years ago today, and now the stock is at $45. So obviously people are going to hate the stock. As I've talked about a lot in the past, sentiment and talk about a stock follows the stock price. So when the stock drops, that's all that's going to be said. Year to date, it's been hammered again. They got rid of Alex Chris as the CEO. A lot of people sold out because of that reason. The earnings report was fine. If anything, it was slightly disappointing. I've actually, this is one of my longest holdings here. So I was talking about those people back here. I bought the company at about $55 here in 2023. So I've been a long-term bag holder here. If I would have bought, a multitude of any companies in 2023, I could have made a lot of money, even if I just bought the S&P 500. Instead, I'm sitting here, my average is like 60 something dollars because I've continued to add over the years. I'm down like 25% on this over a 2.5, 3 year time period, but it just continues to get more and more obvious to me. Obviously, the growth has slowed in the company. Over the past 1 year, revenue has grown at 4%, which is basically inflation. It's a little bit above inflation, maybe 1.5% above inflation. Over the past 2 years, it's about 5.5%. So it's nothing compared to what it was growing at over the past decade, but it's still growth. The company's still going to be here to stay. And a lot of investors confuse growth with a moat. I see that all the time. People look at a company that's grown at 40%, 50% for the past 3 years, and they're like, oh my gosh, this company has such a wide moat. Look at the growth. Obviously, it's so, dominant, this and that. A lot of times that could just be, a sector holding up a company or a new idea or something that they even, they could have came up with a new product or a service that's revolutionary. But if it doesn't have a moat, if it doesn't have a protection around it that's keeping other people from doing the same thing, eventually that growth is going to come to a screaming halt, and the company will ultimately become a bad investment if you pay the wrong price for it. And that's what this one comes down to. It's the price. So I'm getting this company now, after this sell-off, it's at a 13% free cash flow yield. After dilution, it's close to 11%. And then the new CEO coming in, he's believed to, create efficiency. So this stock-based comp impact should go down to 11.5, a 12% yield. And I'm expecting the free cash flow to continue to grow because of this. So with this insanely cheap valuation, what they've been able to do is buy back shares. Look at this. They bought back 7.5% of the company over the past 1 year. Over the past 2 years, they've bought back 7% per year. Over the past 5 years, obviously, they've been ramping it up as the valuation continues to get like more and more dirt cheap. And the company still has more cash than debt. So they're going to continue these buybacks. The only way this one goes, as a bad investment at this point is if, you see the active accounts is basically no growth. Over the past 1 year, it's up 1%. Sure, whatever. But it's been around 430 million for 3 years now. And these people are going to continue to use the platform. These are a lot stickier than you think. I see PayPal used all the time within my small business. I'd say 20-25% of the payments that we receive from in my company are between PayPal and Venmo. So it's very popular still. And I think the height we ever saw was 3 years ago. We might have had 30% of the transactions within our business come through PayPal and Venmo. But people are going to continue to use this. They're going to continue to get to use the buy now, pay later services. They're going to continue to get credit cards and debit cards on the PayPal system. And that's all going to continue to be increased revenue. It's going to be increases to earnings per share, free cash flow. They're trying out the advertising business. That could be something that takes off, even if it's just a little bit. If it's a 5% boost in revenues or anything like that, anything, any kind of growth here, and this could be a phenomenal investment. I just want to do a discounted cash flow here because it's at such a cheap multiple, 13%. As you can see, I had an example in there with 1% free cash flow per share growth. But we saw that they're buying back about 7% of the company. They're guiding to buy back another 7% or so if it stays in the 40s. Obviously, if the share price blows into the 60s, 70s, 80s, 90s, that's going to bring the buyback yield a lot further down. But if they buy back 7% of the company, if it stays, if their free cash flow stays flat, they have 0% growth, but they continue to buy back 6, 7, 8% of the company per year, that's going to make the free cash flow per share go up, 7% per year. So let's say we have 7% free cash flow per year. They have 0 revenue growth. That means it's gonna be flat. This is their all-time high revenue forever. It's never going to go any higher, despite them still having 440 million active users, and then being able to, offer different things to their customers. Like I said, whether it's credit cards, buy now, pay later, debit cards. They filed for a bank charter. So they're going to have a lot of opportunities to monetize their PayPal platform and their Venmo platform, which they haven't really figured out how to fully monetize Venmo. And that is their fastest growth. They're seeing the growth in that close to 20% still. So I think Venmo has a long way to go. But let's say, like I said, 0 growth. This is basically 0 revenue growth, 0 free cash flow growth, but it is 7% per share free cash flow. And if you're growing at 7% free cash flow for a company that is somewhat sticky, I mean, this isn't the widest milk company in the world, but it's not a commodity. It's not, something that's so replaceable. You can't just get rid of PayPal like that. They do have a lot of competition within payments, whether it's Apple Pay, whether it's Visa, MasterCard, whether it's Google Pay, whatever it may be. They have a lot of competition. But a 7% grower, if you see it with a moat at all, you're going to trade this up to a 6, 7% free cash flow yield. Let's do a 7% free cash flow yield. This is insanely cheap, and you're getting 21% returns per year. If we see any growth, if we continue the 7% buyback and we see 3% revenue growth, so we're looking closer to 10% free cash flow per share growth now, and we trade down to a 6% free cash flow yield, this is incredible returns. I would love to get, if one of my positions in my portfolio had 30% returns over the next 5 years, 30% returns per year, compound annual growth rate, over the next 5 years, going from 45 to 160, I would be, ecstatic. So that's my hesitancy to get out of this position. It's not the widest moat company in the world. It seems like the sink is shipping more and more every day, every week, every year with this company. But like I said, it's not about what the share price is doing. It's about the value you're getting from this company. And I think at this share price, you're paying $45 and you're getting $6 in free cash flow over the past 12 months. It's just too cheap. Those users are going to be very sticky. This one, like I said, like Monish Paprai says, like a 2x4 just hitting you over the head. That's what's happening with PayPal. 3 years ago, people would have done anything they could to get this company at a 13% free cash flow yield. But now that it's here, no one wants it. But that's 4 opportunities that are just screaming at me that I just can't resist those opportunities right now. I know it seems like whenever stock prices are going down, everything's going, the wrong way, but you just have to sit back, relax, and think about, okay, is this company quality? Is this company going to continue to print free cash flow, especially free cash flow per share in the future? If you think yes, if it's at a cheap valuation, if you understand the business, if it's something that you followed for a while and the market's finally giving you a great opportunity to enter and make great returns over the long term, I think now is a time that you should step in. With that being said, if there's companies, if you don't understand tech, if you haven't done a lot of research into tech companies, which is what is being sold off here recently, right now may not be the time for you. Like I said, at least 99% of the companies in the world, you shouldn't even take a look at, you shouldn't even think about. And honestly, I think as time goes on, I will realize that a lot of the companies that I look at, I don't fully understand. For the time being, I do think I understand these companies. I think I understand the direction of these companies. And these are just 4 opportunities that just make no sense to me. So let me know what you guys are buying down below. Don't forget to drop a like and subscribe on your way out. And I hope you guys have a great rest of your day.